Hello, and welcome to Tax Savings Planning for Retirement. Taxes is a big part of retirement, pre and post tax, and today that's what we're going to be discussing. My name is Jim Horrocks. I'm a CEO of TimeScale Financial, located here in Boston, and we also have an office down in the Mid-Atlantic in Virginia. One of the big concerns around taxes is that people often pay more taxes in pre-retirement and in post-retirement due to a lot of different reasons. One, they don't always understand the strategies to help reduce their tax burden. And two, they also don't plan for it. And the thing that really gets people all the time is if you actually do 1 and 2, then the tax laws all change. So today what we're going to do is try to take you through this so that you can get a better understanding of where you are and hopefully take full advantage of the resources to help you get to your goals and pay the most efficient way you can pay taxes and pay Uncle Sam. Our purpose today is to provide you a financial planning framework where you can kind of see how the taxes can affect an entire financial picture. Again, we're going to discuss tax strategies for pre and post retirement. We are going to, as I said, taxes do change. So we are going to do a preview of the proposed Biden administration tax law changes. And then, of course, this is all about you. We want to answer any questions you have and finally offer you any practical guidance and suggestions that we can. At the end of this, you're going to have the opportunity to email us and have a one-on-one consultation about your specific situation if you want. A lot of things we're going to talk about today are really high level, big picture of what could be for different circumstances for people for taxes, but it may not affect your particular situation. So sometimes it's really good to make sure you get one-on-one advice to help you. Also, during this presentation, there's going to be some poll questions that pop up, mostly just to get a little bit of information, but also see if you're paying attention and make sure you're following along with us. So you'll see those as it comes along. One of the things we always like to say is, this is kind of like a disclaimer. Anytime you're talking about taxes, laws, anything like that, please make sure you use some professionals to help you. We always debate how big the tax law book is today. Some people say 17,000 pages, some say 11,000. I don't care if it's more than a couple hundred pages, it's a lot. And you really need to make sure that you're dealing with, when you're trying to help in your own situation, make sure you have some professionals around you who know those laws and do it every single day so they can help you get the most out of your money. So let's get right into it. A financial planning framework. So this is what we think is really important for understanding your financial plan and how taxes affect it. So let's look at what a financial plan looks like. First, everything should start with your goals. You see it right there in the center. It's all about you and what you're trying to accomplish. Then there are 2 parts. Phase number 1 is coordinating, consolidating your assets, while phase 2 is about protecting and conserving your assets. So in phase 1, there are 3 parts. There's spending, what you do every single month, a budget. Part 2 is savings. That's when we set money aside to pay upcoming expenses. For example, like college education, or just having money set aside for maybe buying a car in the near future. Third is investing. This is where we take your money, hopefully take on some risk, and your money makes money for you for longer term goals. Finally, once we get all your resources coordinated and consolidated and working in the right direction, we work on phase 2, which is tax planning. As one of those, it's really important to make sure we pay Uncle Sam efficiently. If you're managing your money the most effective way, and let's say you had a great year and you're up 20%, but if you're giving half to the government, well, that doesn't really make a lot of sense. So we want to make sure we're constantly monitoring taxes. Finally, there's risk management. This is a big fancy word for insurance. Protect for the unforeseen if anything ever happens to you. And then lastly, estate planning. Anything ever happens to you, you want to make sure your assets are facilitated the way you wanted them to be done. So we work on all 6 of these together around your goals to make sure you're efficiently getting there. And then also we can start to measure what matters most to you in each one of these buckets, because for each person, your goals are different and your plan should be different. And how you measure them should be the same way. So it's a complex world, this tax world, as we talked about. So you really need to make sure we have a tax strategy plan while you're trying to accumulate assets, and also when you get to retirement and how you're distributing those. There's been a lot of changes. There's no child tax credits anymore. Mortgage interest deductions are gone. There's a lot of different changes around the 401k contributions and medical insurances, security requirement minimum distributions. And then again, I say that things change all the time. So we're going to try to get into some of this stuff tonight and help you become more efficient about how you're managing your money. Like I said before, we're going to be talking about pre-tax, when you're saving, how to become flexible with the tax code. We're going to discuss post-retirement, talk about some of these hidden aspects of the tax code. I say hidden, they're not hidden, they're there, but they're in about, like we said, 10,000 pages somewhere around Medicare, Social Security, Roth Conversions, beneficial IRAs, and charitable giving. We're going to touch on all of those tonight. And then lastly, like I said, it all changes, and we're going to look at some of the proposed things that are out there that they're trying to pass right now. So our first poll question just came up, and the question that I wanted you to answer is, are you currently retired? So this is a really easy one, just a yes or no. So the question is, are you currently retired? So please put in your answer. You know, and as you would expect, as things are coming in, or at least I would have expected, we're getting a nice mix of people who are retired and who are not. So that's actually good, because right now we're going to be kind of focusing on the people who aren't retired, and it's the pre-retirement group, the ones who are trying to accumulate. What we notice the issue then this time is that many people don't know their after-tax retirement income picture looks like before retiring. It's very important to understand where your assets are and what you need to live on. Let's give an example. So many times people come to us and they'll say, hey, I've been saving for a long time. I have $500,000 in my 401k, and that's where all my assets are. Well, look, that's great. You've done a nice job of building up your assets. The challenge, though, is that all of the money is tied up in a retirement account, where every time you take money out of that, you're going to have to pay tax. So the first thing that goes into my mind, if that was the case, that maybe this $500,000 really isn't $500,000. Maybe it's only $325,000 if the person's in a higher tax bracket, or a little bit more if they're in a lower tax bracket, because there's no flexibility with the tax code. We're going to have to pull it out. No matter what we do, we're going to have to pay taxes. The perfect world story is if you can get to the point where you have some you have retirement money, which we all do, because we all try to do 401ks, but to have some tax money, non-retirement money. So you've already paid your taxes in here. So when you take money out of here, you don't have to pay taxes on what you put in. And when you take money here, you do pay taxes, so that you can kind of play with the tax code a little bit based on where you take your income from out of the two accounts. Hard to do sometimes, but it's a really great way to do it. It's important to understand the tax code, right? Here is the tax code as it stands in 2021. If you're married, filing joint, right down the middle column there, singles on the left. But if you're married filing joint, you can see there that if you make income from 0 to 19,750, you pay at 10%. Then if you go from 19,751 to 80,250, now you're in the 12% range. But once you go over that 80,000 as a joint couple, you jump from 12% all the way up to 22. That's a big jump. But then if you already have that much of an income, which some people do, you're going from 80,000 to 171, you're at 22%, but you can go just a fraction higher, 24%, all the way up to 326,000. And then that's the next big jump, is up to 8%. So it's important to understand those breakpoints and where those jumps come from, and helping you manage how to save for retirement and understand the tax code. So as we talked about before, if you're someone who has a lot of money in just 401k retirement money, maybe there's some other options of ways you should save money. So let's look at all the ways that you can save money pre-retirement. First, what we call the now category. Pay our taxes now, and we won't have to pay them later. What kind of accounts are those? Well, you can do a Roth IRA. With a Roth IRA, you pay taxes now, you put it in the Roth, it grows for you, and you're at retirement, you take it out without paying tax. You also can just do a regular brokerage account. That's just a regular outside account, just a bank account, brokerage account, that's Schwab or Fidelity, wherever you are. You pay your taxes now, goes into that account. You don't have to pay taxes on that money you put in there. Excuse me. The taxes later, we can defer taxes. We all know about this one. It's like the 401k. We didn't pay taxes when it went in. It grows tax-free for us, but then we pay the taxes out on the other side. So that's all your traditional retirement accounts, 401ks, 403bs, 457s, and like we said, traditional IRAs. There's a category where we may never pay taxes, and we got to be careful. Health savings accounts. If you can put money into their pre-tax, And if you use the money later in retirement for qualified medical expenses, you may not have to pay taxes on that money at all. So there's a lot of different ways to save your money so you can put it in different categories so you can have flexibility around the tax code about where you take your money at retirement. So that was a lot on the pre-retirement, but now let's focus a little bit on post-retirement. When you finally made it to that great time of retirement, you may be in a situation like here, like Sam and Mary, where they actually have done what we hope you do in pre-retirement, where you spread your assets into different type of accounts. So you can see Sam and Mary have $450,000 in their IRAs. So when they take money out of there, they're going to be taxed. Sam has a Roth IRA with $600,000. Doesn't have to pay tax on that one. They have a joint account where they put $300,000 in. They don't have to pay tax on the money that they put in there because they've already paid it. And then finally, Mary has an HSA. So we've got all the different categories to use for them at retirement. So let's talk about what they're trying to do at retirement. They want to spend $110,000 a year. So they have different sources. Their Social Security, between both of them, are going to give them $38,000. This is just a made-up example. And then their investments, all of those investments in all those different categories, at 4% a year, they can take $72,000 a year, which makes up their $110,000. The challenge is where do you take that $72,000? Remember I said before, if all you have retirement money, you're going to have to pay tax when that money comes out. So in order to net $72,000, you may have to take out $100 to net $72,000. But because Mary and Sam have their money spread around, they have options. How do we plan to do this? What kind of things can they do to take advantage of the situation they put themselves into? Well, let's talk about Roth conversions. You can take your IRA and convert it to a Roth, and there may be some times where it's a very valuable thing to do. Taxable amount converted is added to your income. So what that means is when you take money out of a retirement account, like we said, it's taxable, but maybe we can do some things that are really a great tax strategy for you all the way through retirement. So remember the tax brackets we looked at before? Remember that first 0 to 19,000 was 10% and so forth? If you look at the top line here, this is called before conversion. These are the buckets of the tax code. So if you have a certain amount of income coming in, so just like Sam and Mary, right, they have $38,000 that comes in from Social Security, that's taxable. And then they need that other 72, that's $110,000. They're going to fall into the 22% tax bracket. So they've used all the 10%, they've used the 12, and now they just use a little bit of the 22. A great tax strategy here may be for them to pull out more out of their IRA to fill up the 22% tax bracket. They may not use the money. They may convert it, like we're talking about, into a Roth where they pay the taxes now, let it be deferred for later, where they don't pay any tax. But they get the money out at 22% taxes. That's what's most important. So they get it out at a lower amount. And if you do it over a long period of time, you can drive down your IRA and hopefully take it out at lower tax rates than maybe you will have to do in the future. In some cases, we would say to people, hey, it's only a 2% jump up to the 24% tax bracket, and that one's around $327,000. Maybe you should take out even more and fill up that bucket. But again, depends on your particular situation, and you should, seek advice to make sure it's the right thing for you to do. But that is a Roth conversion that people are doing, taking money out of the IRA and putting it into the Roth conversion while they're at a lower tax bracket. So as I said, when is this a good time to do this? It's really for people in low income years. Some common examples that we talk about are business owners that know that they're going to have a really low sales year. They're going to have really high expense year, so they're not going to have big, high profits. When you have a year where you have big medical bills that may be driving your income down, it may be time to take out more of the IRA and convert it to the Roth. And then finally, when you're in retirement, but before you're taking on Social Security or any pensions or any IRA distributions you have to do, this also may be a great time to take money out of your IRA and convert it to a Roth. So just some really good ideas and things for you to think about, because a lot of times people say to us, hey, I'm not going to take any money out of my IRA until I'm forced to. Well, that may not be the best case for you, because once you're forced to, they're telling you how much you got to take out, and that goes up every year as you get older. So you may be jumping tax brackets because your IRA required minimum distribution is very large. So this may be a great strategy for you. Another poll question has come up. Do you plan to itemize or take a standard deduction this year? So if you don't know what that is, a standard deduction is basically just standard. So if you're filing and you can just take a certain amount off of your gross income, or you can itemize. That means you have a lot of different things that you do where it allows you to have a deduction like charitable deductions and so forth that will allow you to itemize. And we got a lot, and then one of the questions has, or you don't know. So we got a few people said they're not really sure, but we got some others mostly mixed again. But it seems like mostly people are doing standardized itemization. So let's talk about another thing you can do in post-retirement. And it's around charitable giving. And there are some things that people do in this situation that they may not realize they're making kind of a small mistake here because it's causing a taxable implication to them. So once again, let's do an example. We've got Albert and Shirley here. They're in the 24% tax bracket. They want to give $10,000 to charity. They have $13,000 of existing itemized deductions. And the standard deduction for 2021 is actually $25,000. So if they don't do anything, they're probably just going to do the standard deduction. But let's talk about this. If they actually gave $10,000 to charity, they're going to get no deduction for it, because the only thing they have to itemize is $13,000. They're going to do $10,000 to charity. That's only at $23,000. The standard deduction is already over that at $25,000. So they're not going to get any deduction for doing that charity. Maybe there's a better way to do it. So one of the ways they could do things is called a qualified charitable distribution. It's something that you must do after you're 72 years old. What you can do there is, if you want to give $10,000 to somebody, maybe do it through your IRA. Give it directly to the charity. And you can do this up to $100,000 per person. The amount. So let's say, again, they want to do that $10,000. It counts toward their requirement distribution, the amount they have to take. So now the amount they have to take, $10,000 of it won't be taxable. They send it directly to the charity, and now they get to deduct that $10,000 against their income, where before they couldn't under the example we gave earlier. Option one, so there's other options of ways to do this. Again, kind of repeating what I've already said, if we gave the charity directly, if we just took $10,000 that Albert and Shirley have, they gave it to the charity of $10,000, that $10,000 is now going to be, if they took it out of the IRA and gave it directly to the charity, so they took it out of the IRA to themselves, gave it directly to the charity, they would have $10,000 of reportable income. If they're in 24% tax bracket, it costs them $2,400 to do that. And then the cost to the charity is, for the $10,000 you tried to give away, the real net effect is $7,400. So you end up paying $2,400 to give away $10,000. If you just did the $10,000 from your IRA directly to the charity, it's now excluded from taxable income. And now you save the $24,000 in taxes, and the charity gets the full $10,000. So a much more effective way for people to give money to charity than what we were originally just thinking. I take it out of my IRA and I just hand it over to them. Nope, you want to get it directly to them, and that's called the qualified distribution. There's another way you can give money to charity, and under this example, let's say that Albert and Shirley want to give away $10,000 every year. They're in option one, and they take the standard deduction because if you see as you go down line year 2020, their charitable deduction they want to do is $10,000. They have other deductions of $13,000, so it's only $23,000 total. But the standard deduction in 2020 was $24,800. So they're going to take the standard one regardless if they gave the money to charity or not. In option two, if you put $20,000 in 2020, in that year, into a donor advised fund where you were allowed to dole out that money, you would now have a deduction of $20,000. You have other deductions just like you did in option one of $13,000, but now you have total itemized deductions of $33,000, much higher than the $24,800 of what the standard is. So now you would use your itemized deductions of $33,000. Now you may say, hey, I'm not going to have anything for 2021, but in 2021 you'll use the standard deduction. So what happened there? You can see at the very bottom, over 2 years, you would have done a much better job in option two of having deductions against your income of $58,100 versus $49,900. A much better situation. And again, taking advantage of the things that you may want to do anyway, which is give $10,000 a year to charity. This may be a much more effective way for you to do it and help reduce your taxes. Hidden taxes. I love that term. You got to be careful with the word hidden, right? It's not hidden. It's in the book there. It's in the laws. It's just hard to find. Not many of us want to read the entire book. So let's go over some of the ones that are hidden out there. Here's an example to watch out for Medicare, the IRMA cliff. IRMA just means it's an adjusted rate for how much income that someone may be taking in. So here's George and Martha. They have Medicare Parts B and D. They're retired. They have a very high adjusted gross income of $275,000 in 2019. What this just means is they're living on $275,000. That's income coming to them, whether it's from pensions, Social Securities, or retirement accounts, whatever it is. And that's what they're living on. So in this particular year, they decide to sell a stock in one of their accounts where it has a gain of $1,000. So if you have a gain of $1,000, the standard tax on that would be $188. It's about 15% for the long-term capital gain, and another $38 for a 3.8. It's an extra tax that's in the code for capital gains. So they'll pay 18.8% to sell that, to have that gain of $1,000, right? That's what it should be. No big deal. Well, if you don't know what's going on with the IRMA, you just may have caused a little bit of a problem for yourself. Here is a chart that talks about married people, and single people. You can see all the breakpoints there. So what this is basically saying is based on the level of income that you are being taxed at, your adjusted gross income, your Medicare Part B premiums are changing. So what happened is, as we said, our couple in our example had incomes around $275,000. They now, because of the $1,000 gain on their stock, pushed themselves up to the next bracket. They're now going to pay additional money to Medicare Part B of around $180 a month. That's a month. So, but that's not where it ends there. Now, for their Medicare Part D that they have, they're going to pay an additional $39,000 a month because they popped themselves to that next category. So without really realizing it, in 1 year for selling a stock that gave them $1,000 gain, they have now increased and combined themselves to an increase of $2,604 on their Medicare Part B and D. So their premiums have gone up by that much for the year. Excuse me. So what does this mean? You sold a stock for $1,000 income gain. You have to pay the capital gain of $188, like we said, but that sales triggered the IRMA on Medicare, which puts you in higher brackets to pay higher premiums in Medicare. So you got surcharges of $2,600 and $2,604. So that $1,000 that you got as a capital gain triggered you to have $2,792 in taxes, which is a 279% real tax rate. I know that's crazy, but that's what it does. You've got to be really careful of these breakpoints in Medicare that you don't pop yourself up or down based on your income. And many people don't realize that, and that's why we call it a hidden tax. But now you know. Here's an example of a Social Security hidden tax. I love this one. So here's a person that gets $1,000 extra in income, and somehow this is going to lead to a 40.7% tax rate. How can that happen? Well, let's take a look. Before you, I'm sorry. So Bill wanted to take $1,000 out of his IRA to take a trip. So before he takes the trip, he had IRA income of $38,000. You see the big circle there. And his Social Security benefits are $25,000. His adjusted gross income, what he's going to be taxed on, is $56,525. Now, hold on. $38,000 plus $25,000 does not add up to $56,000. But what happens is, based on certain income levels, just like Medicare, you don't pay all of your Social Security that you receive. You don't pay all the tax. It's based on what your income is. And there are different brackets for it. So here's what happened. Bill took out that extra $1,000. So now his IRA income went up to $39,000. Still is collecting the same Social Security benefit of $25,000. But his adjusted gross income, what he's going to be taxed on, went up to $58,375. And his taxes now went up by $400 and change. So with these two scenarios, he has changed his tax implications dramatically. So before the trip, he was going to pay taxable income of $42,275, and now he's going to pay $44,125 because he took out that $1,000. He increased his adjusted gross income, and it's cost him $1,850. For every $1,000 he took out, it was charging him $1.85 was added to his adjusted gross income. So he took out $1,000, it added $1,850 to his adjusted gross income, which caused his taxes to go up significantly because now he was going to pay a little bit more for that Social Security. So what does that mean? That $1,000 he took out to take that trip now cost him $407 because of the added money that went to his adjusted gross income. So that $1,000, he's only going to net $593. So kind of sad if you don't realize what you're doing with these hidden taxes and how it's going to affect you based on different income levels, based on your Social Security, based on your Medicare. You really got to pay attention and watch all the different parts. So we talked about pre-retirement, how we can have some tax strategies there to help you and the thought process that you need to have. You get into post-retirement, talking about some of those hidden taxes and other ways to give to charity and other ways to do Roth conversions. Now let's talk about how taxes can impact an estate plan. And these have been some changes in the rules that just happened. There used to be a thing called a stretch IRA when someone inherits an IRA. Well, that's changed a little bit. Let's talk about Pamela. Pamela is 65 years old, and her son Kyle, who is 40, is the beneficiary on her IRA. Pamela dies and leaves 100% of that IRA to Kyle. The IRA balance is $400,000, and we're going to use 6% as an average rate of return for this example. Scenario 1, Kyle. So now the new rules say that Kyle can't stretch that over a long period of time like he used to be. He used to be able to stretch it over his lifetime. Now with the new rules, Kyle must take a distribution over 10 years. Now he can take it any way he wants over that 10 years, but he must take it out by the end of the 10th year. So let's just say Kyle's like, hey, with a 6% rate of return, I did a little calculation. If I take out $54,000 and change a year, I have to pay tax and all that, but it's only $54,000 a year. So maybe it won't be so bad for him. But scenario 2, Kyle decides not to do anything. Let the money grow. He's like, hey, I want to let the money grow in there. It seems to make a lot more sense. But in year 10, that $400,000 at 6% a year grows to $716,339, and he must take it out all in 1 year. He is going to pay significant taxes. He's going to pay significant taxes on that $716,000. It's going to put him in the highest tax bracket right away in that year 10. So again, that may be okay because we don't know what Kyle has for a job. Maybe he's in a high tax bracket every year, but maybe taking it a little bit over time is better than waiting to the very end. But you need, again, get some guidance on that. But the key part of this discussion is the rule has changed. No more doing it over Kyle's lifetime, which might have been over 25, 30 years, 40 years even. He now has to do it over 10. So that's a dramatic change in estate planning, especially for parents who want to give money to grandkids, because grandkids can be really young when someone passes. And that stretch was really long, not anymore, 10 years. So it has changed the way we look at estate planning and beneficiaries of retirement accounts. And remember, kind of ties back to our discussion of the Roth conversion. If you, as the parent, or in this case Pamela, if Pamela could take out that money a little bit at a time at a lower tax bracket and drive that retirement account down, when Kyle inherits it, it's a lot less. And so, well, you may say, wait a minute, Kyle didn't get as much money. If Pamela took out that money and put it in a non-retirement account and gave both accounts to Kyle, now he has one that has less of the 10-year rule he has to worry about, and the other money comes clean to him, where he doesn't have to pay any taxes on it because Pamela paid the taxes for him, and in a lot of cases in a lower tax rate. A lot of things to think about when it comes to the estate. So as I said, we talked about tax strategies pre and post. We talked, even there was some charitable things. After all of these tax law changes, worrying about Medicare and Social Security, guess what they do? They're going to come out and change the tax laws. So Biden is coming out and doing that now on September 13th in 2021. They sent out a proposal. There is a long list of things that they're proposing. We thought what might be interesting for you is to look at maybe 5 things that are happening. The capital gains rules changes, ordinary income tax changes, qualified business income deductions. That's really if you own a business. We'll talk about that. The gift and estate tax exemptions that they're talking about changing. And then finally, we talked about Roth conversions tonight. They want to change some of the things that we have already even talked about. So let's look into these a little bit deeper. The capital gains law. They want to basically take the capital gain rate and increase it from a maximum of 20%. So today's the max is 20%, and they want to increase it by 5% to 25%. The interesting part about this rule is that they want to make it effective for September 13th, 2021. So that means even if you try to sell something now and this tax law goes into effect, you're going to be under the new tax law because they're trying to do a little bit of retro before it goes into effect or into law. So just be wary of that. So this is what they're talking about doing. Originally, there was a lot of discussion that they wanted to double the capital gains from 20% to 40%. And what's now being proposed is going from 20% to 25%. In addition, please remember there's always a 3.8 net investment income tax would always apply. The ordinary income tax. So you may say to yourself, oh, I'm not in the top tax bracket. This is only affecting the top tax bracket. Hold on a second. You are correct. They want to increase the top bracket from 37% to 39.6%. Again, this is before those surcharges and the other things we talked about. So they're just taking the bracket and moving it up. But here's what they've also done. The top bracket used to start at a much higher level. They're now talking about bringing the top bracket down so that you can see on this slide, this would apply now for ordinary income in each one of those brackets, as you can see. So like couples married filing jointly was $450,000. The top bracket used to start at over $600,000. So they're bringing that bracket down. So more of the money will be affected by the top bracket. Third, this is for business owners, and these are for business owners that own S-corps, partnerships, and so forth, and have pass-through income. There's a current law that you get a 20% deduction off of your qualified business income flowing through partnerships and S-corps and some other entities as well. So what that meant is if you had a business and you made $100,000 in profit and you would have to normally pay taxes on that $100,000, well, now you get to deduct 20% away, so $20,000 you don't have to pay taxes. They're talking about basically eliminating this deal and proposing legislation that would set a maximum limit on the deduction. So, for example, if you're a married couple and your total income is more than $500,000, this goes away. You cannot have a 20% deduction anymore. And you can see the other levels that they're looking at as far as income levels. So again, if you make too much money as an adjusted gross income or taxable income, this benefit that you used to have as a business owner now may go away. The gift and estate tax exemption, this is another thing. Remember, these are all proposed. I'm not telling you these have changed yet, but this is what's being proposed. Right now, this death tax in the United States for the federal government is $11,700,000. They're talking about dropping that down to $6,030,000. And again, they'll have an increase for inflation going forward, but basically cutting this in half starting now. It was supposed to on December 31st, 2025, go back to it in back to $6 million in 2025, but now they're proposing to do that basically starting January 1st. So again, just a proposal, and for many of us, this doesn't necessarily affect us, but for a lot of people, it does. The federal tax is a very high tax. It starts at 45%. So what that means is once you're over $6 million, or today it's $11,700,000, but if it changes, once you go over that, the tax rate starts at 45%. So it's a very big tax, but it's a death tax. And then finally, the backdoor Roth conversions and rollovers. So remember earlier, we talked about someone who had low income, maybe wants to take more money out of their IRA and convert it to a Roth. Well, making after-tax deposits into an IRA, So the part I was just describing to you about low income taking money out of the IRA, that's kind of bullet point 2 here. They're going to eliminate that. They made a proposal that they would not allow people to roll partial IRA monies into Roth. So they want to take away the great benefit that we were telling you about earlier. They also want to take away a thing called a backdoor Roth. We didn't talk about that much today, but that's a way to put money into an after-tax IRA and then convert that IRA to a Roth. They just want to eliminate that altogether. And then if that doesn't work, beginning in 2032, for taxpayers with adjusted gross incomes above certain thresholds, they want to get rid of Roth conversions altogether. So it may sound like they're getting rid of Roth conversions altogether here. That's not true. Bullet point 1, they do want to get rid of backdoor Roth. Bullet point 2, they're talking about getting rid of basically partial rollovers. So you can still do a complete rollover. So that means you have to take your entire IRA and move it over to a Roth. But then in 2032, they're talking about over certain income levels, they won't even allow that anymore. So again, these are proposals, not definitely going to happen, but there's things to be starting to think about as far as when it comes to planning your future when it comes to taxes. So we had another poll question come up. Do you believe that taxes will go up in the future? The answer is yes, no, maybe. I'm not sure. Hard to predict the government. Well, it's a really difficult thing to do. It's a hard assumption to make. For many people, they believe taxes are going to go up in the future. And wow, many of you feel the same way, that taxes will go up in the future. And if they do, it's important to plan now. Maybe paying taxes today is better than paying them later in the future. But really depends on your particular situation. And again, listen, if you want to request a tax and retirement planning overview meeting, we are here to do that for you. We want to help field your questions inside of a financial planning process. So if you do want to get help, please contact Joe Yoon, a colleague of mine, works here at TimeScale Financial. His email's right there. We'll be here to assist you. Joe is fielding all the questions as they're coming in. So it's jyoon@timescalefinancial.com. And we'd love the opportunity to work with you and help you reach your financial success and having your money work the most efficient way for you. I hope today you found some great information. I always have to throw up the disclosure. I hope you got some good information for yourself. And again, remember, this was high-level view, but it's important that you, when you're thinking about yourself, that you really work with a professional to understand how these tax laws are going to affect you and what's going on in your particular situation. So thank you for your time tonight. Hope, like you said, you got something good at it. And if you would like some additional help, please contact us at jyoon@timescalefinancial.com.